The property management business model is broken. The problem with third-party property management is that management companies are simply paid too little to really make sense of their business and of their efforts in regard to managing multifamily properties. What I mean by that is the industry standard compensation for a property management company is 3% of revenue. This is in terms of 100 unit, 200 unit properties. Obviously for smaller single family or duplex, fourplex, it could be a 5, 8, even 10% management fee, which is more reasonable because there's less scale. But when you start talking about bigger scale multifamily, the management fee goes all the way down to 3%, and in some cases even less. And the reason why this is problematic is because that management fee is too small for a management company to really pour its heart and soul into optimizing the operations of that property. And so what happens is management companies, in order to turn a profit, they need scale. They need to manage 10 properties in a given location, and they can spread their corporate team and their accounting team across those properties so that they can actually have a profit. Because if a management company only manages one property in a particular market, it's actually going to be losing money on that endeavor because it's going to have to hire the overhead to manage in that certain geography, and one property is simply not going to cut it. So the trouble with this is when you're an owner and you hire a third-party management company to manage for you, you are relying on them to actually care about your operations and to treat the property as if it were their own, which in most cases is not going to be true. And that's especially true when you're talking about Class C properties, because Class C properties have lower rents. So you could be talking about $1,000 rents, and if a property is $1,000 per rent average, 100 units, that's about $100,000 a month in revenue, and if they're making 3% on that, that's $3,000 a month. That barely covers their costs for them to do accounting. So they don't have the money to hire a regional manager and other people to train, and the hiring personnel and the recruiters and all these things that go into managing a very people-intensive business. You can't do those things and still be profitable. So the third-party management company, in the most perverse sense, it has the incentive to get hired and to do just a good enough job to not get fired. But obviously, just a good enough job is not good enough, especially when you're talking about workforce housing, where it's a daily grind and you really need the best people who care the most and who are going to put their time and effort into managing the property and squeezing all the potential profits out of the deal. This is why you hear sophisticated investors talking about vertically integrated operators. Like ourselves at LSCRE, we have in-house property management, so we can afford to do things that a third-party management company simply wouldn't do. We can buy a property in a new market and spend the money and actually lose money on the management side because we're really not in it for the management, we're in it for the ownership. And we're in it for the ownership and investment with our investors. So that's a major upside case for vertical integration versus hiring third-party management. With that being said, neither option is perfect. There's certainly downsides to vertical integration, but if you look at the biggest and best operators in the country, almost all of them, probably virtually all of them, are vertically integrated. And you know what else is interesting is even some of the biggest property management companies that really market themselves as a property management company first, they oftentimes are owners themselves. Think like Greystar, think like BH Management. A lot of these platforms, while they go around marketing themselves as a management company and they have hundreds of thousands of units under management that they provide as a third-party service for a fee, they also have their own portfolio. So when you consider that, you think about a management company working for your property, but it's not theirs, right? They're always going to spend more time and effort and bias their resources towards their owned portfolio, not their fee-managed portfolio. Now, I'm not calling them all out and saying that they don't do a good job. Many of these companies do a great job. And similarly, if you're vertically integrated, it doesn't guarantee that you'll do a good job either. But that is a perverse incentive as well when the third-party property management company also owns property in the area, because like I said, they're going to be biasing their resources to their own portfolio rather than their management portfolio. So regardless whether you're vertically integrated or using third-party management, it's very important for the management operations to have scale in that area, because that is it's not just a differentiating factor, it's also a risk mitigant, because when we own property in a certain area, and that means we have a lot of personnel in that area, more boots on the ground, more eyes and ears. And so if a manager at a certain property happens to quit one day, we have extra resources to come and help that property. And it's much more challenging to do that when you yourself only own one property in the area, or if the property management company that you've hired and are relying upon, if they similarly only own or only manage one or a handful of properties in your given location.